Do you often wonder how the likes of Warren Buffett and William O'Neill managed to sift through thousands of listed companies to find potential investments? Have you ever questioned the effectiveness of your own investment strategies? It's a vast sea out there, and navigating through it can be daunting, yet the titans of the investment world seem to do it with an uncanny ease. So what's their secret? Well, they don't attempt to evaluate every single company. Instead, they narrow down the list by considering specific financial ratios. It's a lot like playing chess. You don't randomly move your pieces around the board. You strategize, you eliminate ineffective moves right from the beginning. That's what leads you to victory. Understanding financial ratios is like playing chess. Eliminating ineffective moves early on can lead you to victory. Investing isn't about copying the moves of popular YouTubers or Twitterers, it demands your knowledge and experience. So how can you find those golden investment opportunities? Let's talk about some key financial ratios that can guide you in this journey. Firstly, company valuation is crucial. It's like shopping for a deal. You want to pay as little as possible for the most value. Imagine if you could buy a dollar's worth of a company for only 50 cents. That's the magic of finding a company that's undervalued by the market. Financial ratios like price-to-earnings ratio or PE can help you assess this. Secondly, a company's ability to generate cash is key. Cash is the lifeblood of any business. It pays the bills, fuels growth, and provides returns to investors. Here, the cash flow margin and free cash flow yield are your friends. Next, consider the company's financial stability. Debt can be a double-edged sword. It can fuel growth, but too much can become a burden. The debt-to-equity ratio, or DE, can give you a good idea of a company's financial health. Let's not forget about growth. Consistent growth is a sign of a company's ability to adapt, innovate, and succeed. The compound annual growth rate, or KGR, of a company's revenue or earnings can give you a snapshot of its growth trajectory. Then, consider the company's management. Experienced and dedicated leadership is a crucial ingredient for success. While there's no specific ratio for this, you can look at the track record of the management team, their tenure, and their past performance. Lastly, consider the company's economic moat. This refers to a company's competitive advantages that protect it from rivals. Again, no specific ratio here, but you can look at market share, brand strength, and proprietary technology, among others. Eliminating companies that don't meet these criteria saves time and focuses attention on better opportunities. Remember, the aim of the game isn't to consider every possible move, but to make the most effective ones. Just like in chess, the goal isn't to play every possible move, but to play the best ones. How do you identify excellent investment opportunities? Today, with the advent of investment research platforms, this task has become simpler. These platforms like ticker.com, offer a wealth of knowledge and tools at your fingertips, enabling comprehensive analyses of stocks from across the globe. Imagine having the ability to filter through thousands of potential investments to identify those that meet your specific criteria. It's like having your very own financial advisor working around the clock, but without the hefty fees. Ticker.com, for instance, provides a robust platform where you can delve deep into a company's financial health, scrutinizing everything from its earnings to its debt structure. It's like having a microscope that allows you to examine the intricate details of each company, helping you make more informed investment decisions. The first step is valuation, asking, is this stock expensive? It's akin to buying a dollar for 50 cents, a secret to becoming a great investor as shared by Warren Buffett. Platforms like ticker.com are instrumental in making this evaluation. It's great if you can buy a dollar for just 50 cents. That's the secret to becoming a great investor as shared by Buffett. Now, how do we go about determining whether a company is undervalued or overvalued? This is where a metric called trailing total enterprise value to earnings before interest and taxes, or TEV/EBIT, comes into play. Picture TEV/EBIT as a tool that helps us assess the true value of a company. Total enterprise value, or TEV, is calculated by adding a company's market capitalization to its total debts, then subtracting its cash and cash equivalents. Earnings before interest and taxes, or EBIT, is a measure of a company's profitability. When we divide TEV by EBIT, we get a ratio that helps us understand how much we are paying for each dollar of a company's earnings. Why do we prefer TEV/EBIT over the price-to-earnings, PE ratio, you may ask? Well, the PE ratio only takes into account the market capitalization of the company and its earnings. It does not consider the company's debt or its cash and cash equivalents. As a result, The PE ratio can be misleading, especially for companies with a significant amount of debt or cash. On the other hand, TV/EBIT provides a more comprehensive view of a company's financial health. It penalizes companies with poor balance sheets and benefits those with strong ones. If a company has a high TV/EBIT ratio, it might be overvalued. Conversely, a company with a low TV/EBIT ratio could be undervalued, providing a potentially profitable investment opportunity. However, it's crucial to remember that this is merely one tool in your investment toolkit. It should not be the sole determinant of your investment decisions. Also, understanding the company's business model, industry, and growth prospects are equally important. Eliminating companies that you don't understand helps focus better on potential opportunities. So keep learning, keep assessing, and keep investing wisely. Growth is also critical. A company can generate a lot of profit and regularly pay you as a shareholder if it has a high return on assets, often abbreviated as ROA. This ratio is an indicator of how efficiently a company utilizes its assets to generate profit. Companies with a high ROA are often those with strong operational efficiency and robust management strategies. It's a key metric that reveals a lot about a company's success. Now let's talk about revenue growth. Some investors believe that growth is the most important variable to consider when valuing a stock. While past growth does not guarantee future success, companies that have consistently demonstrated revenue growth in the past, barring exceptional years like during the COVID pandemic, often indicate strength and competitive advantage. Steady revenue growth can signal to investors that a company is expanding its market share, improving its product or service offerings, or benefiting from a growing market. It's a positive sign that the company is on an upward trajectory. Another important metric is the net profit margin. This is the percentage of revenue that a company retains as profit after accounting for all its costs, taxes, and expenses. A high net profit margin indicates that a company's board is excellently managing the company's variable costs. It's a testament to the efficiency of their operations and their ability to control costs while maximizing profit. Moreover, a high net profit margin represents the company's strengths and potentials. It suggests that the company has a competitive edge, be it in its pricing power, cost control, operational efficiency, or all of these. It's the kind of company that can weather economic downturns and emerge stronger. In conclusion, when investing, it's crucial to look beyond just the price of a stock. Consider the company's growth trajectory, its return on assets, and its net profit margin. These factors can provide a clearer picture of the company's financial health and future prospects. Remember, the goal is not just to invest, but to invest wisely. A high net profit margin indicates excellent management of variable costs by the company's board and represents the company's strengths and potentials. Use individual filters and indices to find investment opportunities that align with your personal strategy. This is the essence of smart investing. You see, there are other variables that can further refine your search for the perfect investment. Let's talk about a few of them. First, consider the discounted cash flow rate. This is a valuation method that estimates the value of an investment based on its future cash flows. Simply put, it helps you assess whether a company's stock is overpriced or underpriced based on its projected earnings. Next up is the return on equity, often abbreviated as ROE. This measures a corporation's profitability by revealing how much profit a company generates with the money shareholders have invested. A higher ROE indicates that the company is using its investors' funds effectively. Now let's talk about shareholder profit provision. This is essentially the portion of the company's profit that is allocated to shareholders. It's usually expressed as a percentage. A company that consistently provides a higher profit share to its shareholders can be a promising investment. But above all, remember this. The key to successful investing is conducting your own research. Sure, tools and platforms like tcar.com can help you analyze and filter companies, but these are just aids. Your understanding of the company, its financial health, its growth prospects, and the industry it operates in is what will ultimately drive your investment decisions. As Warren Buffett once said, never invest in a business you cannot understand. So take the time to understand. Read financial reports, follow industry trends, and keep an eye on market news. Remember, successful investing requires your research and understanding, rather than relying on others. So, start exploring and happy investing.